Lufthansa just told investors the Strait of Hormuz closure will cost it an extra $2 billion this year, not in some distant scenario, but as a line item in its current guidance. On the same day, the average price of gasoline in the United States crossed $4.50 per gallon, the highest level since July 2022. Those two numbers share the same origin, a 9-week closure of the strait that normally moves roughly 20% of the world's traded oil. The mechanism matters here. The Hormuz closure does not just reduce supply, it reroutes it. U.S. fuel exports surged to a record 8.2 million barrels per day last week as countries scrambled to replace Middle East product with American refined goods. That looks like a win for American exporters, but it is simultaneously draining domestic inventories. U.S. crude stockpiles fell another 2.3 million barrels in the week ending May 1st, according to EIA data. The market is drawing down reserves while producing at a record export pace, a combination that does not self-correct quickly. Asia is absorbing the deepest structural shock. Asian economies import 85% of their oil from Persian Gulf countries, and import volumes fell 30% year over year as the blockade held. Some economies are already reporting stagflation-adjacent conditions, slowing growth with rising energy-driven prices. The port of Fujairah, positioned just outside the strait on the UAE's east coast, has become the region's emergency bunkering hub, but it was not designed to carry the volume now flowing through it, and Iranian strike activity has already targeted it once. The aviation layer adds a second transmission path. Germany has now arranged jet fuel imports from Israel after Berlin determined its domestic supply chain could not bridge the kerosene shortage from the Middle East. That is not a normal procurement event. It signals that European energy infrastructure is being rewired in real time. Lufthansa's $2 billion warning puts a direct number on what disrupted jet fuel markets cost a single carrier in a single year. Airlines without hedging programs or strong balance sheets face the same math with fewer tools to absorb it.
What interrupted the Hormuz spiral, at least for one session, was a report that Iran is actively evaluating a U.S. peace proposal. Oil briefly dipped below $100 a barrel. The S&P 500 pushed to a new all-time high. The TSX climbed over 1%, led by miners. And gold, which had fallen roughly 11% over the 10 weeks of the conflict as high-rate fears overshadowed safe haven demand, surged 3.6% in a single session to above $4,700 an ounce. The gold reversal exposes a chain that ran in an unexpected direction during the conflict. Normally, war pushes gold higher. This time, the war pushed oil higher. Oil pushed inflation expectations higher. And higher inflation expectations reduced the probability that central banks would cut rates. Because gold yields nothing, a high-rate environment is structurally bearish for bullion, regardless of geopolitical fear. The 11% drop during active war conditions is not a failure of the safe haven thesis. It is evidence that inflation risk was dominating the signal. The peace rumor inverts the chain. If Iran accepts a deal, oil normalizes, inflation pressure recedes, and rate cut probability recovers. That is the sequence that drove the 3.6% single-session gold spike. Silver followed, rising more than 6%. The Bank of Canada, which has held rates as oil-driven inflation complicated its policy path, has now signaled that July projections will not shift materially once the government's fiscal update is incorporated, meaning the BOC is watching the oil channel closely without committing to a direction. The counter-signal, as one metal strategist at Xanner Metals framed it, is that the market can pivot on Middle East headlines in either direction. Trump's own statement on the deal included a qualifier. Iran must give what has been agreed to, which is perhaps a big assumption. That conditional sits directly underneath the market's relief rally. If the deal stalls, the rate cut probability retreats, oil resumes its climb, and gold faces the same structural ceiling it encountered during the conflict's worst weeks.
The Hormuz shock is external. The Honda story is internal, and it reaches further into Canadian economic policy than energy prices alone. Honda is indefinitely suspending development of its $15 billion electric vehicle and battery complex in Ontario, a project that was central to Ottawa's strategy of positioning Canada as a North American EV supply chain hub. The plant was slated to begin operating as early as 2028. That timeline is now open-ended. The causal chain runs through Washington before it reaches Ontario. U.S. tariffs on Canadian auto parts and shifting U.S. domestic policy on EV subsidies have altered the economics for Japanese automakers building North American production capacity. Honda is pivoting to hybrids as its core North American strategy, which requires different manufacturing infrastructure than the all-electric complex it announced for Ontario. The $15 billion figure was not just a plant. It carried battery supply chain commitments, workforce training agreements, and federal and provincial subsidies attached to EV-specific production volumes. Prime Minister Carney acknowledged the situation in broad terms, referring to challenges with the U.S. tariffs and committing to work with automakers. He did not mention Honda by name. Finance Minister Champagne described the pause as global, pointing to similar EV delays in Europe and the United States. That framing is accurate. EV adoption curves have softened across major markets, but it obscures the Canada-specific risk. The government structured significant industrial policy around EV commitments that are now unwinding before a single vehicle rolled off the line. The verification point for this chapter is whether Honda makes an official announcement in the coming days. The company told Canadian government officials this week that they're going to be in touch soon publicly with their medium and long-term plans, according to Carney's parliamentary secretary. If that announcement confirms an indefinite halt rather than a delay, it will require Ottawa to reprice its auto sector support framework, including how it deploys the billion-dollar steel and aluminum lifeline it announced this week in response to increased U.S. Section 232 tariffs. The two pressures, trade tariffs and EV retreat, are hitting simultaneously, and the policy tools designed for one do not straightforwardly address the other. If oil prices stabilize on an Iran deal and rate cut expectations recover, the broader investment climate may improve enough to pull some of these decisions back towards Canada. If not, the Honda pause may prove to be the first in a sequence. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.